Hi there, and welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, brought to you by Livewire Markets. My name's James Marley, and in the last episode, Ali Selby was speaking with Dom Rizzo from T. Rowe Price, who was explaining why he thinks AI is the biggest productivity-enhancing technology since electricity. If you haven't listened to that episode, I reckon it's worth doing. I really enjoyed it on my drive down just the other day. Now today, I'm joined by Sebastian Mullins, Head of Multi-Asset and Fixed Income at Schroders. And we're going to be delving into some of the macro factors that are playing out in global markets right now. We're talking rates, inflation. We also want to find out why we haven't had a recession, because everyone said it was coming. And Sebastian's also going to share where he sees value for the major asset classes that form the building blocks of many diversified portfolios. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so that you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. And if you're not a Livewire subscriber yet, we'd love to have you on board. Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from some of the leading investment minds in the country. With that, Sebastian, I'd like to say welcome to the Rules of Investing. Great to have you in.
Thanks for having me, James. Appreciate it.
Okay, so finally we can breathe and exhale a little bit. It looks like central banks are at the start of what's a bit of a coordinated easing cycle. We were hoping to get here. What's your take on how this is all playing out at the moment?
Yeah, thanks, James. I think markets can sometimes get this wrong, but right now we're definitely at the start of a rate cut cycle. We thought that last year, market expectations were pricing for everyone to start cutting rates, and of course it didn't happen. This time around, I've actually seen central banks start to cut. So we've had, for example, the ECB, so the European Union, started cutting rates. BOE, so Bank of England, the UK cutting rates, but also Sweden, Denmark, Canada, even New Zealand. So you are starting to see sort of this coordinated rate cut cycle, at least in the G10. If you think about the notable exception there, you've got Japan, obviously, who have only just started the rate hike cycle from minus 0.1% to 2.5%.
It scared the life out of everyone, didn't it?
Yeah, it scared everyone, because I think in that, if you're hiking rates while it's small, from minus 0.1 to 0.25, so 2.5 by accident, 0.25, while the Fed's cutting rates, and at least in that, well, the market's pricing in cuts for the Fed, that makes a big differential, so it makes the yen rally, and of course that sort of blew up the system for a couple of days. But if you think about the markets that haven't cut rates, and I guess the US is a notable exception, they have, however, flagged that they will cut in September. They said pretty much everything they could to solidify a rate cut in September after Jackson Hole. But again, Australia is also an exception. You know, we saw Bullard be quite hawkish in our comments. And unlike other central banks that have already started a rate cut cycle, it's less clear here. So I wouldn't say everyone is cutting rates, but the big players definitely. Brazil's potentially raising rates. So it depends on the inflation dynamics. But broadly speaking, global inflation is falling, and we're starting a rate cutting cycle finally.
Okay, as I said, people breathing a bit of a sigh of relief, but it hasn't really kicked off in earnest just yet. We haven't even had a cut from the States. What do you think happens from here, and what are people expecting to happen?
I think it depends on your view of what happens in the US economy, because, I mean, our base case is still a soft landing. Now, of course, that was everyone's view, and it probably still is quite a few people's view, but you can't have a soft landing without softening. And I think that's where it gets really muddy, where you start to see softening in the economy, and it's always easy in hindsight after revisions have come through, but when you're living it, that fine line between a softening and a recession is quite blurry. So we saw the jobs report come out recently in the US that, along with the yen rally, caused panic, and the markets went straight to pricing in an emergency 50 basis point cut out of cycle. Now, of course, we've moved beyond that, but the market's still pricing sort of 50-50 chance between a 25 basis point cut in September from the Fed to a 50 basis point cut. The market's not sure, it's around 50-50. Mm-hmm. But if you look at forward pricing using futures, for example, there's quite a lot priced in already. So, for example, there's already 100 basis points, or so-called 4 cuts, priced in for the end of this year.
Yep.
And that sort of goes against the Fed's dot plot, which, to be fair, was only in June. So a lot's happened since then, but they expected only 5.1% as a sort of the rate by the end of this year. If you jump forward to next year, there's another 100 basis points of cuts. So 200 basis points of cuts to, I think, even this point next year. And if you go all the way to the end of 2025, the market's pricing in a terminal rate, or a rate at December 25 of 3.1, whereas the Fed's saying 4.1. So 100 basis points difference in 2 years' time from what the Fed was saying in June to what the market's now pricing.
Yeah.
So I think if you still believe in a soft landing, that's quite aggressive. So front-ended curves are probably pricing in too many rate cuts, and that might sort of, lead to disappointment if that comes out. That said, if you're expecting a recession, there's a lot more that could come in.
Yeah.
So far more cuts will happen if we have a hard landing. So right now, it really depends on your view between the hard and soft landing based on what's priced in the US.
So you've got a chart that shows those projections in the US. We'll chuck it up on the screen if you haven't seen it already. What about the Australian story?
So the Australian story, again, you look at the chart as well on the right-hand side, it looks like they've priced less cuts in the system. Obviously, the dynamics here are a bit different. If you think about the inflation rate we had at the end of the quarter, it was quite lucky that it came in below expectations. If you looked at the monthly prints, there was quite a lot more expected. So the fact that that quarterly print was lower gave the RBA a sigh of relief, effectively. They didn't have to hike rates. Obviously, the speech afterwards was quite hawkish, and they're saying they'll not sort of hesitate to act if inflation rises again. So that is far more hawkish than, say, the Federal Reserve, who are telling you they're going to cut in September. And I think the difference there is, of course, I mean, for whatever you want to call it, there was a lot of interference last year on the RBA. Phil Lowe taking questions from parliaments, and you had Chalmers out there saying you don't need to hike as aggressively, and that meant we weren't able to get rates higher or as high as needed compared to other countries. So right now, inflation's falling quite nicely in the US. It's sticky here.
Yeah.
So it's more of sort of a stagflationary environment here. Throw into that, you've got fiscal spending, both from state and government, federal government. That's estimated, I think Westpac's saying around $50 billion, or 2.2% of aggregate demand just on spending. And that doesn't include the tax cuts, state tax cuts. So that fiscal stimulus is keeping the economy going and probably keeping prices high while the Reserve Bank's trying to, put the brakes on. So because of that, there's less priced in terms of cuts in Australia, as you can see here, which is probably more realistic. But I think the path there is probably going to be a bit more volatile because we're one inflation print away from the RBA hiking, effectively. So a big difference between the US and Australia.
Yeah, it really is. Let's stay with Australia. One of the news items that caught my attention over the past week or so was that the big four banks have started cutting the interest rate that they'll pay you on their term deposits. What should we take out of that? Are they preempting the RBA's move? It seems like it could be a bit of there doesn't seem a lot of certainty around what the RBA is doing. It could be a bit of a cheeky maneuver.
Well, I mean, you got their own benefit of cutting rates. Obviously, paying less, the banks, I should say, paying less to consumers obviously helps their bottom line.
Yeah.
But I think they're just pricing in with the forward markets or the futures market suggesting. So you can see in that chart, it does suggest that the market is pricing cuts. Our view is probably that's a bit aggressive, short term at least, but they're probably just following that curve.
Yeah.
So in 1 year's time, we probably will have cuts, but there might be a hike in between. We're not certain of what the path to that 1 year point will be. But I think banks like CBA, et cetera, their job is to effectively follow that forward curve.
Yeah. So Seb, at the start of the rate hiking cycle, everyone told us that, the rate hiking cycle ends with a recession. We had the most aggressive rate hiking cycle any of us would have lived through, but we haven't yet had that recession. So if that is the peak of the interest rate cycle, where is the recession? What happened to this big thing that was going to hit us?
Well, it's a good question. I mean, we talked about Australia kind of already about that fiscal stimulus coming through, and Australia is not the only country. US, again, had extreme fiscal stimulus. Their budget deficit now is 6% of GDP. So first point is it's hard to get a recession when the government's pumping money into the economy.
Yeah.
Now, that's something we haven't seen in a long time. Usually since, say, the GFC, obviously you had targeted programs to bail out banks and stimulate the economy, but on average you had very, very loose monetary policy and very sort of tight fiscal policy to preserve the balance sheet, improve the fundamentals of both the corporate and government balance sheet. This time around, it's sort of the reverse. We're hiking rates, but the government's stimulating aggressively. So that has offset quite a bit of it. But if you think about the US, because that's where I guess most of the recession indicators have been flagging red. You mentioned the rate hike cycle, very aggressive, highest in 40 years. But also the yield curve had inverted for probably the longest period in living memory. So that is normally a recession trigger. The question is, what does that mean? It means, very basically that monetary policy is tight. cash rates are higher than long-term expectations. So typically when that happens, something breaks. So you start cutting rates because the economy is imploding, because someone suffered. When you have a highly levered economy, that's what happens. The US went into this not levered. If you think about what are the pillars of the economy, you have the consumer, you have corporates, and you have the government. So government spending for everyone else. The consumer, in the US at least, they delevered after the GFC, so 2008. They reduced their actual amount of debt to GDP. At the same time, they went from being, say in 2007, 25% of household debt was floating rate. Now it's only 11%. So they delevered and fixed more.
Yep.
And the biggest investment's obviously there. So the biggest debt is their home loan, and they fixed that at very good rates. So current US home loans are around 7% 30-year, but the majority of people locked in between, let's call it sub 4%. So not feeling that huge interest rate.
Good for them.
Good for them, exactly. They timed it very well and they did their right
Good
job.
on them.
And they locked it in. Now, it's not to say they're not suffering, but if you look at this chart on the left-hand side, one way to show how much debt can a person have before it starts to hurt, we're looking at household debt service payments, so how much money you pay for your debt, divided by divided by the disposable income you receive.
Yep.
So how much money you're receiving and how much you're paying out. You can see here, if you ignore the COVID distortions, government handouts, debt jubilees, etc., it's the best time to have debt in 40 years. So let's say in aggregate, the consumer is fine. Parts of it, yes, there's pockets of weakness, pockets of extreme jubilance, but in aggregate, they're fine.
Yeah. Jobless rate still pretty low.
Jobless rate's low, real incomes are up. People who are sort of more susceptible to not having wealth in the stock market, et cetera, are getting higher pay increases. So in aggregate, they're fine. So they haven't had a recession from the consumer side. On the corporate side, it's similar. Not that, Apple is the economy, but let's use Apple as an example. They termed out their debt in 2020. They issued a 40-year bond, coupon at 2.55%. They did similar, it's like a 7-year bond in 23 for about 3.55%, well below the cash rate now.
Who wouldn't want to lend to those companies?
Who want to lend to those companies? So you think about Apple, they've got $1 billion in debt owed, but they've got $100 billion debt owed and $160 billion sitting in cash. So they got more money in cash than they owe, earning 5.5%, paying off debt that's less than that. So they make more money off their cash than they pay out in their debt.
Yeah.
And that's true for 35% of tech companies in the US. So again, you'd expect higher interest rates to crack corporates. It didn't. It's in a way benefiting some of the corporates. And on the right-hand side, a way to show that in aggregate is non-financial corporates. What is their net interest payment? So similar, what do they have to pay minus what do they receive in cash payments? And that's the best since 2008. So again, corporates in aggregate fine, households in aggregate fine. Who's hurt from interest rate hikes? It's been the government. So the US expenditure on interest expense is higher than defense. It's higher than Medicare. So it is the largest expense for the government. So in aggregate, households fine, corporates fine, government's suffering, but in a way that's almost fiscal stimulus. If the two pillars of the private economy are fine, or the public economy are fine, and the corporates are all fine, then there's no recession. Yeah. So for us, interest rate hikes haven't hurt those two pockets.
Sebastian, the picture you've painted there sounds pretty benign. We've got an election year coming up, a lot of promises, I imagine. There's a lot of investment that needs to go into things like energy. There's all of the investment going into data centers, chips, AI, big long-term thematics, which seems to me it could be quite inflationary. So what happens to inflation from here? Has it really been tamed, or is it potential for it to kick off again?
I think you have to look at it in different timeframes. So in the short term, inflation is definitely coming down. We're not saying it's going to go back up to what it was a year or two ago, where in the US you had almost 9% inflation. We're not saying that's going to happen. Inflation is definitely falling from that peak. But I think to your question, structurally, over the next 5 years plus, are we going to see the same disinflationary forces that we saw, say, post-GFC? And we believe the same as you that there are more inflationary forces in the system now than they were over the past decade. Yeah. If you think of some of the structural drivers for that disinflation you've had things like productivity. That's probably still fine for disinflation. Your previous guest knows more about AI than I do, but that should be helping bring inflation down. But the other major factors are things like fiscal stimulus. That's here to stay. You're seeing more populist governments come in around the world. You're talking about the election in the US. They're both going to spend. Doesn't matter who wins. It just depends on who they spend on. But there's no Tea Party candidate or fiscal conservative. The only fiscal conservative leader out there is in Argentina right now, Milei. The rest of them are looking to spend to get votes. That's more inflationary. You've got deglobalization. Now, I'm not saying we're going to stop making things overseas, but the pendulum swinging back in the other direction.
Yeah.
You've talked about friendshoring, even onshoring. So I think that is more inflationary than it has been before, because you can't outsource everything to China, and you can't have this sort of hyper specialization like Taiwan is the only country that can make chips. That has to reverse if we're thinking we're going into a regime where you have to have security of supply, but also security in general. So spending on military defense, spending on cyber defense, security of food, security of minerals, that's all inflationary. I think the final point is demographics. Historically, aging demographics means inflation goes lower, which is probably true for most countries, especially countries like China. You saw it in Japan. US, not so certain, because they have these two big cohorts that were in the savings camp. Think about your retirees, they save before retirement, but you also had the younger people who couldn't afford to do anything. They weren't having kids, they weren't buying houses. They're both sort of saving. Now they're both shifted into a dissaving environment. The retirees are spending, they're not saving, they're not earning as much anymore because they're just in their consuming phase. And the younger generation, the millennials, are starting to actually have houses, have kids, buy houses, etc. So that moves in aggregate from a saver to a dissaver. So that might also be inflationary in the medium term. So all that to say, we're not saying we're going to 1970s style inflation, but if in the US 2% was the ceiling of inflation for the past decade, we think it's going to become a floor.
Yeah.
So it might be between 2 to 3, maybe 2 to 4, but effectively that disinflationary.
But that's what central banks were kind of hoping for, because everyone was, they threw the kitchen sink at trying to spark inflation. So maybe that's not such a bad thing for us. Let's transition and get into the asset classes and think about investing. As I mentioned in my introduction, you're a multi-asset class investor. You build, that means across equities, bonds, the full spectrum. What do you think looks cheap and what looks expensive right now? How are you thinking about putting together that multi-asset portfolio to do a job for investors at the moment?
Well, I think valuation is always interesting because they tell you a lot long-term, but not that much short-term.
Yeah.
And long story short, things that are expensive for a reason, things that are cheap for a reason. So if you go through equities in general, US equities stand out as being expensive. There's no doubt about it. Relative to their own history and relative to other equity countries, regions, I should say, the US stands out. But they're delivering excellent earnings and they have free cash flow. And the Mag 7, or whatever you want to call them, they're excellent companies delivering and they have monopolistic pricing power. So expensive for a reason.
Oh, they're ubiquitous. I mean, it's incredible. Yeah. I was chatting with my wife just the other day and saying, think about how much you engage with all of these companies on a single day, whether it's doing a Google search, using your iPhone, ordered something on Amazon. They're fully entrenched in our lives. They're incredible businesses.
And we're going to become more entrenched because if you think about moving to the cloud, it makes sense. It's cheaper for corporates and for people. But once your data's up there, if you don't keep paying, you can lose it. Yeah. So you get sort of trapped in the system. So it's very positive for those companies. And there are very few countries that have companies like that. So you want to be invested in the US for those companies. But because of that, it's an expensive market. Yeah. So say expensive, but we gave the reason of why we think a soft landing. Expensive for a reason. We think there's high quality companies. Australia is also expensive, but doesn't necessarily have the same kind of pull of, say, the Mag 7. And CBA, for example, has a higher price to earnings ratio, PE ratio than Google. So make of that what you will. But for us, the Australian market looks expensive, but there's no real justification for why it's that expensive. So we would prefer the US to Australia, despite the US having a higher PE ratio in general. We think it's expensive for a reason, whereas Australia is less certain. Yeah. Now, markets that are cheap, Japan was cheap before it corrected 25%. It's even cheaper now after the crash. Of course, it's rebounded off those lows, but that is cheap and we like Japan. Europe is cheap as well. It's probably too early to call the bottoming of the economy there, but there's some green shoots. But China is extremely cheap. But again, cheap for a reason. Yeah. So you're not seeing the stimulus. You're seeing great exports, but not much local consumption. So again, very, very, very cheap, but you're not seeing the catalyst to re-rate just yet. So I think long story short, nothing screams as cheap that you have to buy today with the macro backdrop. Yep. But again, nothing's so expensive that you have to just start selling assets. So I think the market in aggregate is pretty well balanced in equities, but you want to be sort of tied to those super earners, as we call them.
And so do I take it from that your equity position is generally, the bulk of it's in US equities, a bit in Australia, and a very small amount in some of those emerging markets?
Correct.
Is that sort of the framework?
Correct. And I think what's cheap, protection on the US equities is cheap. You can buy put option for historically cheap levels. So we're long equities, long US, but have protection. So we prefer the US equity market to the Aussie equity market. Now, multi-asset, we've also got other asset classes. It's the reverse for credit. US credit spreads are very, very tight. You're only getting about 5.5% in US dollar terms. You hedge that back to Australia, you get like 4.5. It's not that great.
Yeah. Whereas
Aussie credit spreads are very wide. Historically speaking, they're wider than the US, which never happens because our credit quality is a lot higher. But you can get very, very attractive yields on Australian credit, say between 6 and 7%, depending where in the stack you go. So we prefer Australian credit over US credit, but US equities over Aussie equities.
Yeah. Okay. Well, I want to talk about fixed income markets because owning long duration bonds, core bonds, has been pretty painful for quite a long time. And these have been historically the building blocks of a multi-asset portfolio. We talked about things rolling over with the rate cycle and peaking. So simple question, is now the time to have some duration in the portfolio, particularly in that fixed income part of it?
I think yes. The question is, what's your time frame and why are you using it? So, I mean, that's a bit of a wide answer, but we talked earlier about how much cuts are already priced in curves. So for us, the US front end looks expensive. So if you're buying bonds, say 2 years or 5 years, you're probably going to be disappointed given how many cuts are in the system unless you have a recession. Mm-hmm. That said, if you want to have high quality income in the portfolio, you're getting a yield now on some of these assets. It's come down over the past few months, but it's still a very high quality yield.
Yeah.
And if you are worried about recession, you'll do very well to protect your equities. So I think as an equity hedge, it's sort of working again. And if that muddied area of slowdown to recession flips into recession, you'd want to have a lot of duration to protect your equities. But more tactically, which our job in multi-assets get the timing right as well, we would wait for some of those cuts to come out of pricing. And that might take a month.
Yeah,
the market's gone from 5% yields to 3.5.
Right. So right now it's looking a bit skinny.
Right now it looks a bit skinny on the front end, but as a structural allocation, it makes a lot more sense now than it did 2 years ago. So I'd be saying yes, buying, but you probably get a better entry point in the next couple of months.
You mentioned recession, then we talked about it earlier. Have you assigned a probability to the chance of there being recession?
We have a long, complicated model, but it has 20 indicators. About half of them are flashing red right now.
Yep.
So that historically would be a warning sign. But the overwhelming majority of it is in the middle section, which we call effectively, is the central bank tight? And we know the central bank is tight, but we also know they're about to start cutting rates. So that will start to switch off once the Fed starts to cut rates. There's nothing in the imminent recession components of that model to say one's coming in the next 6 months.
Yeah.
So for us, it is still flagging recession risk, but we're discounting it because it's not imminent, and the components that are red will turn off pretty soon.
You can see a pathway.
Exactly.
It's amazing. Yeah. One of the other dynamics in markets, and we touched on the performance of those stellar US mega caps, but the rally has been very concentrated and hard to keep pace with. Is there a point where that starts to broaden out, or is there a new dynamic with these mega cap companies that's kind of changed where the returns come from in equities?
I think our view is a broadening out will occur.
Yep.
And I think people sometimes frame that as those expensive, high-flying stocks everyone loves should crash back down, in which case there's a readjustment. Our view is not that's going to occur, but the rest of the market will play catch up. So if you think about even just the equity performance in the last, say, month or two, since the end of June, you've seen the Russell 2000 small caps in the US, Dow Jones, let's call it more sensitive to the economy in the US, and even an equal weighted S&P, which is where you take all the 500 stocks and just weight them the same, they've all outperformed the actual S&P since the end of June. So people are starting to price in that rotation trade. It had a hiccup in August, obviously, with everything selling off, but it's now from point to point is ahead. What that tells us is we think because we're starting a rate cutting cycle, the more economically sensitive companies typically on average have more floating rate debt than say your tech stocks. Yeah. So they have suffered more and they're more linked to the real economy or manufacturing, which has been in a recession for 18 months. So if you're cutting rates, that will give them the biggest reprieve So they're starting to play catch up. Based on our view of a soft landing, rate cuts, and then fiscal stimulus coming, whoever wins, that should see the rest of those companies play catch up. So long story short, we think the rotation trade in the US is the other 493 play catch up, as opposed to the Mag 7
giving up
back
their
down.
gains. Yeah.
And when it comes to other markets, I sort of mentioned Europe, there's some green shoots of things improving. Not that Sweden is the European economy, but it's a leading indicator given how open the economy is and based on trade. If you look at new orders in Sweden, they're off the charts, which typically leads to global manufacturing recovery and gives some view of what might happen in Europe as sort of that trading component of Sweden sort of flows through. It's like a leading indicator on Europe.
Yeah.
Same thing for China, like Taiwan exports are off the charts, mainly chips, but it's showing you the global trade is recovering, global manufacturing might recover. So you might start to see the rest of the world catch up. So long story short, rotation within the US, but the economy is sort of slowing from, let's call it great to good, not good to recession.
Yep.
So still good, but just less good. Whereas the rest of the world might start to be recovering out of sort of the doldrums to play catch up next year. So for us, broadening in the US, yes, but maybe the rest of the world catches up sometime next year.
Yeah. We're going to get into our three regular questions in just a moment. But as I sort of listen to all of this backdrop and this scenario, and this is something I've been thinking about for a while, but it feels like central banks have done, and actually they've done a really good job of kind of navigating this path through the higher rates. And there's a few pain points here and there. But as I look across and listen to what you're saying, it sounds like it's a pretty great environment to be an investor. You can earn income on defensive assets. There's plenty of growth options within equities. Last week, the Australian market piled on 10 consecutive gains post that sell-off. Do you think investors are right to be bullish? And the flip side to that is, what are you worried about?
That's a good question. So I think in general, when you had higher inflation, you had the 2022 sell-off in everything other than commodities and US dollar. Every asset fell, bonds, credit, equities, you name it. That's the re-rating of risk premium. It hurts when you're going through it, but once you're through it, it's a far more healthy environment to invest. So like you mentioned, some equity markets are expensive, but nominal GDP growth, because they're based on nominal earnings, if inflation's higher and growth is higher, they'll do fine.
Yeah.
At the same time, credit's repriced, wider spreads, and the actual sovereign component is higher than zero. While it's no longer 5%, let's say the US 10 years, we're in sort of the high threes, that's a lot better than zero. So you are getting risk premium rebuilt. So in aggregate, it's a far better time to be an investor. I would prefer buying most assets over cash at this point. For long-time term deposits were the place to be, 22 especially, because everything fell. Cash did all right. Whereas now, if cash rates are coming down, the attractiveness of cash is falling, and the attractiveness of other asset classes is improving.
Yeah.
So I think it is a better time to be an investor now than it has been. Plus, you're getting some, volatility back in markets. So there are different business cycles in different countries.
Opportunities, yeah.
You can rotate between asset classes. Before, it all fell and rose together.
Yeah.
So I think it's a far more healthy environment compared to the post-GFC period. This current environment is more normal than we've seen, say, in the past decade.
Okay, well, there's too many smiles around here. What is keeping you up at night? What's the one thing you're worried about?
Well, I think that, like I said, when you're doing it in real time, discerning between a slowdown and a recession is very tough. Mm-hmm. Like during the GFC, they didn't know there was negative GDP print until pretty much Lehman's collapsed. Because
6 months after?
6 months after, yeah, because all the revisions came through after the fact. Yeah. We even saw recently there was about 800 jobs in the US that didn't exist that was overstated.
The recount of the jobs report,
well, exactly.
Gave everyone a heebie-jeebies, didn't it?
So if that happens more, then maybe we're wrong and we are heading into recession. But so far, nothing is showing us that. So we're remaining in the soft landing camp until that falls through. That said, there are parts of the economy that are starting to crack. I've said everything in aggregate, but think about consumers. You're seeing credit card delinquencies in the US go up. People paying their home loans in arrears, that's going up. So there are signs of things cracking, but if the Fed manages to cut rates appropriately, that would help soothe that area. So for us, it's understanding where the bodies might lie. So, one person might blow up and bring the whole economy down with us, like a Lehman's, not our base case, but it's always after the fact you find out who blew up.
Yeah.
So for us, it's trying to look at leading indicators, looking at the sort of micro data, looking at the pockets of weakness. For example, we mentioned lower income consumers, but also some of the private credit companies that don't have access to public financing. They are relying on floating rate debt. So they will have more pain then those corporates that could refinance sort of longer dated listed debt. That said, many treasurers solve that by hedging out their interest rate risk, but some don't.
Mm-hmm.
So again, it's finding out where the bodies lie in the slowdown and how much of a slowdown do we have. Still smiling faces and telling you why we think things are more bullish, but again, it's that fog of war when you're coming into that slowdown versus recession that can be tough to navigate.
Yeah. Well, let's dive into our three regular questions. Let's start with a story of a big win or a big loss from your investing career. What happened and what did you learn?
I think that's a great question, but it's always more hard to relate when it's multi-asset. I'm not going to talk about a company and its earnings and all the rest of it. So
that's right. Just as long as you lost money, that's all.
Lost money. Okay,
about.
we'll start with losing. No, I think for multi-asset, ultimately, your job is to get turning points, right?
Yeah.
During a bull market, you want to be invested and you can get relative value of where is more attractive than others. But ultimately, if you get the slowdown wrong or the recession wrong or the recovery wrong, that's when you kind of make earn your chops as a multi-asset investor. So I think for that, we can pontificate on markets as much as we want, but the performance of your portfolio dictates, how you actually manage those cycles. So for us, I'll get to the loss in a moment, but we're very quick with our process to get out of risk in end of 21. We still draw down in 22, but we then added back at the sort of low in 22. Mm-hmm. So getting those turning points right is what we do.
Yeah.
I think what's important there is when you're buying when the market's panicking, you have to really be solid in your investment process to make sure that you understand where the market should be. Because it's very hard when volatility is spiking, the market's panicking, the newspapers are talking about doom and gloom to then buy equities.
Yeah.
So for us, having that investment process and being, trusting it is very, very useful. So where we got things wrong, I guess, was more recently. So if you think about 2023, the whole world, including us, a recession is nigh. So the model I mentioned before, imminent recession was flagging risk. We got out of equities. Then you had a banking crisis in the US. Credit Suisse blew up. For us, that was confirmation bias that a recession was here. Mm-hmm. And obviously then we had the AI boom that came out of nowhere for us and his equities rallied significantly. So for us, that was a mistake. That's where we gave up potential gains. That said, when we were looking at why we cut risk, first it was a recession, then it quickly morphed into those recession indicators turning off. And we actually went for sort of a higher for longer view when the market was sort of saying soft landing.
Yeah.
So while we missed the rally, bond yields then went to 5%, equities then corrected 10%. So for us, when the market was panicking, again, our process was pointing more solidly to a soft landing. It was when recession, higher for longer, soft landing, whereas the market had another soft landing in between. So when that correction came, we were more confident to buy it than the market was at the time. So while we gave up a huge run, it then corrected back down. We bought equities back around 3% higher than when we sold them. So pretty no-case scenario.
Yeah. And
then September, October 23 onwards, obviously markets just went up. So believing in your process, understanding when to buy when markets are extreme, but also understanding that market sentiment can go longer than you expect. Maybe you take chips off the table too soon, but we'd much rather buy the safe part of the rally, which is despair to hope, than hope to exuberance. So I think that's what we've learned from these cycles we've experienced over the past couple of years.
Well, let's talk about sentiment and emotion. What do you think investors are getting wrong about markets right now?
Depends on your view of soft or hard landing. So right now, both are pricing in two different things in equities and bonds. So if you believe in a soft landing, equities are pricing that in. Bonds have probably got too many cuts priced in. So if you view a soft landing, bonds are wrong, equities are right. If you think we're going into a recession, then obviously equities are completely wrong because they're close to all-time highs and bond yields are far further to fall. Based on our conversation, we still believe in soft landing. So we think bond pricing, especially in the front end of US curves, is probably too aggressive, and that will sort of come out of the market.
Yeah.
So again, depending on your view, either equities or bonds are right.
Okay. Final question, and I frame this given your objective of staying ahead of investing and getting returns to stay ahead of inflation. Which asset class is most likely to deliver inflation-beating returns over the next 5 years?
I think over 5 years, equities always win into that time frame, right? Because while valuations are stretched now, they're not so stretched that we think we're going to have a huge correction or a GFC style sell-off. So over 5 years, our view is inflation higher, but nominal growth higher. Sorry, real and inflation higher. So nominal GDP higher, which is good for equities. They might not be as stellar as outperforming inflation if markets were cheaper, but they're still going to outperform inflation. So I think equities are fine over a 5-year period. That said, because we've seen risk premia reprice across all assets, I think most assets will actually outperform inflation. If you think about, we mentioned even credit, if you're getting 6 to 7% yields, we don't think inflation is going to be that high over the next 5 years. So you can lock in those yields, likely outperform inflation. Government bonds, though, if you think about what inflation break-evens are on inflation-protected bonds over a 5-year point, in Australia, if inflation is higher than 2.3% over the next 5 years, you're better off being in inflation-linked bonds and sovereign bonds. And the US is 2% break-even. So if you think inflation is going to be higher than 2% in the US, you mentioned that thinks it's going to be a floor. And if you think the RBA target is 2.5 and the break-even's 2.3, you can even buy tips and likely outperform inflation. So for us, it's a far healthier environment, but we have to say equities are probably the top of the list in that scenario.
Okay. All right. Well, Seb, thank you so much for coming in. I always enjoy getting that big cross-asset class view and a great deep dive into this a fascinating point of the cycle as well. So thank you so much for coming in and being part of the Rules of Investing.
Great. Thanks, James. Thanks for having me.
For all of you listeners out there, remember, hit the subscribe button on the podcast or video player that you're listening to. Means you'll stay up to date with all the episodes that are coming out on the Rules of Investing. We've got some great ones coming up.